Good morning, and welcome to the Ryder System second quarter 2026 earnings release conference call. All lines are in a listen-only mode until after the presentation. Today's call is being recorded. If you have any objections, please disconnect at this time. I would now like to introduce Ms. Kayleen Candela, Vice President, Investor Relations for Ryder. Ms. Candela, you may begin.
Thank you. Good morning, and welcome to Ryder's second quarter 2026 earnings conference call. I'd like to remind you that during this presentation, you'll hear some forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. These statements are based on management's current expectations and are subject to uncertainty and changes in circumstances. Actual results may differ materially from these expectations due to changes in economic, business, competitive, market, political, and regulatory factors. More detailed information about these factors and a reconciliation of each non-GAAP financial measure to the nearest GAAP measure is contained in this morning's earnings release, earnings call presentation, and in Ryder's filings with the Securities and Exchange Commission, which are available on Ryder's website. Presenting on today's call are John Diaz, Chief Executive Officer, and Christy Gallo-Aquino, Executive Vice President and Chief Financial Officer. Additionally, Tom Havens, President of Fleet Management Solutions, and Steve Sensing, President of Supply Chain Solutions and Dedicated Transportation Solutions, are on the call today and available for questions following the presentation. At this time, I'll turn the call over to John.
Good morning, everyone, and thanks for joining us. The Ryder team delivered our 7th consecutive quarter of comparable EPS growth. Solid results were primarily driven by consistent execution on our strategic initiatives. Improving market conditions in used vehicle sales also contributed to our higher results. I'll begin today's call by providing an update on our balanced growth strategy, and will then provide you with key highlights from our second quarter performance. Christy will provide you with an overview of our segment performance and discuss our capital spending and capital deployment capacity. I'll then review our outlook for 2026. Let's begin with a strategic update. Consistent execution on our balanced growth strategy has demonstrated the resiliency of our transform model and has enabled Ryder to outperform prior cycles. By executing on our strategy, the Ryder team built a solid foundation that reflects actions taken to de-risk the portfolio, enhance returns and cash flow, and shift to a less capital-intensive, more resilient business mix. Building on this transformed foundation, our strategic priorities remain focused on executing relentlessly, investing in the future, and growing contractual customer relationships. These priorities are aimed at creating value for our customers as well as our shareholders. Operational excellence is where we stand out and what enables us to leverage our full end-to-end capabilities to solve our customers' toughest logistics and transportation challenges. Investing in customer-centric innovation that enables a proactive supply chain gives our customers a competitive advantage. In RyderShare and RyderGuide, we're embedding agentic AI in order to enhance capabilities and drive the evolution of these proprietary platforms. We're also leveraging AI across the company, including FMS customer service and roadside assistance, where agentic AI is enhancing the customer experience while improving effectiveness. Additionally, we continue to deploy automation and robotics in our warehouses to drive operating efficiencies. We're focused on profitably growing our contractual relationships by increasing customer engagement across our portfolio of port-to-door solutions. Over 90% of our revenue is generated by long-term contracts. Our high-quality contractual base has proven to be a key driver of business model resilience over the cycle and reflects the actions taken to de-risk the model and enhance returns. Our transform model has delivered meaningful outperformance relative to prior cycles, demonstrating the effectiveness of our balanced growth strategy. Our 3 complementary business segments are leaders in North American logistics and transportation, with secular trends that support further growth opportunities. Finally, we're encouraged by the earnings power and resilient performance of our transformed business model and believe that it positions us well to benefit from a cycle upturn. Turning to page 5, key financial and operating metrics have improved since 2018, reflecting the execution of our strategy. In 2018, prior to the implementation of our balanced growth strategy, the majority of our $8.4 billion of revenue was from FMS. Ryder generated comparable EPS of $5.95 and return on equity of 13%. Operating cash flow was $1.7 billion. This was during peak freight cycle conditions. Now let's look at Ryder today. Our revenue mix has shifted towards supply chain and dedicated, with approximately 60% of 2026 expected revenue generated by these asset-light businesses compared to 44% in 2018 as a result of organic growth, strategic acquisitions, and innovative technology. Our increased 2026 comparable EPS forecast range of $14.40 to $14.80 is more than double 2018 comparable EPS of $5.95. Our return on equity forecast of 18% is also well above the 13% generated during the 2018 cycle peak. As a result of profitable growth in our contractual lease, dedicated, and supply chain businesses, forecasted operating cash flow of $2.7 billion is up $1 billion, or approximately 60% from 2018. In 2026, the business is expected to significantly outperform prior cycles, even when comparing the pre-transformation peak to the current market environment. Moving to key performance highlights from the second quarter. Comparable EPS for the quarter was up 12%, making it our 7th consecutive quarter of comparable EPS growth. Results reflect the strength of our contractual portfolio, benefits from strategic initiatives, as well as improving market conditions in used vehicle sales. Return on equity was solid at 17%, in line with our expectations given where we are in the freight cycle. We remain on track to deliver $70 million in incremental benefits from strategic initiatives during 2026. These initiatives are part of a $170 million multi-year program launched in 2024. Consistent execution on these initiatives is the key driver of expected earnings growth this year. And finally, we're encouraged to see continued momentum from improving freight cycle conditions. Contractual sales activity was strong across all 3 segments, reflecting customer confidence. We continue to see improved fleet management and dedicated sales activity, which have been experiencing sales headwinds due to the extended freight downturn. Supply chain continued to generate strong sales activity with record sales in 2025 and year-to-date 2026, reflecting the value of our solutions. Used vehicle sales results were higher year-over-year, and retail pricing improved sequentially for both trucks and tractors. Commercial rental utilization returned to target levels of 75%, driven by our planned asset management actions. That said, market conditions remain below normalized levels, and geopolitical and macroeconomic factors continue to influence the pace and durability of the recovery. I'll now turn the call over to Christy to further review our second quarter performance.
Thanks, John. Total company operating revenue of $2.7 billion in the second quarter increased 3% from prior year, reflecting contractual revenue growth in supply chain. Comparable earnings per share from continuing operations were $3.73 in the second quarter, up 12% from prior year, reflecting benefits from share repurchases and higher earnings in fleet management. Return on equity, our primary financial metric, was 17%, in line with the prior year. Free cash flow increased to $684 million from $461 million in the prior year, reflecting reduced capital expenditures. In Fleet Management Solutions, operating revenue increased, reflecting contractual revenue growth, partially offset by lower rental demand. Earnings before taxes were $150 million, up 20% versus prior year, reflecting benefits from strategic initiatives on choice lease results, as well as strengthening used vehicle market conditions. Used vehicle results reflect a year-over-year improvement and better than expected performance. In rental, utilization returned to our targeted level of 75% on a 15% smaller average fleet. Although demand remained below prior year levels and historical seasonal trends, it was the strongest sequential increase we've seen in 4 years. Rental pricing was up 1% year-over-year. Fleet management EBT as a percent of operating revenue was 11.5% in the second quarter, up from prior year, but below our long-term target of low teens over the cycle. In used vehicle sales, year-over-year used tractor pricing increased 3% and truck pricing increased 6%. Year-over-year results benefited from a higher retail mix due to elevated wholesaling activity in the prior year to manage aged inventory. In the second quarter, 56% of our sales volume went through our retail channel, up from 50% in the prior year and down from 61% in the first quarter. On a sequential basis, overall pricing was stable for both tractors and trucks, reflecting a lower retail sales mix. However, retail pricing for trucks improved 7% and for tractors improved 3%. During the quarter, we sold 5,100 used vehicles, up 500 units sequentially and down 1,100 units versus prior year, largely reflecting the prior year's elevated wholesaling activity. Used vehicle inventory of 8,500 vehicles declined and is within our targeted inventory range. Used vehicle pricing remained above residual value estimates used for depreciation purposes. Slide 20 in the appendix provides historical sales proceeds and current residual value estimates for used tractors and trucks for your information. In supply chain, operating revenue increased 7%, driven by new business, partially offset by lost business in automotive. Earnings before taxes decreased 7% from prior year due to lower automotive results and, to a lesser extent, productivity of new business ramping up, partially offset by benefits from the optimization of our omni-channel retail network. Year-over-year comparisons were challenging in supply chain due to record results in the prior year. Supply chain EBT as a percent of operating revenue was 8.4% in the quarter, at the segment's long-term target of high single digits. In dedicated, operating revenue decreased 3% due to lower fleet count, partially offset by higher pricing. Earnings before taxes were below prior year, reflecting lower operating revenue and adverse development of prior year insurance claims, partially offset by benefits from strategic initiatives. Dedicated EBT as a percent of operating revenue was 7.9% in the quarter, at the segment's long-term high single-digit target. Next, let me cover capital expenditures. Year-to-date, lease capital spending of $605 million was below prior year, reflecting the timing of replacement activity. Our 2026 forecast for lease spending is $1.9 billion, reflecting higher replacement activity versus prior year. Year-to-date rental capital spending of $94 million was below prior year as expected. Our 2026 forecast for rental spending is $200 million. We expect our average rental fleet to be down 11%, consistent with our prior forecast. Our fleet remains well below peak levels. We continue to execute asset management actions that can provide us with flexibility to modestly increase rental capacity in the second half of the year if market conditions were to accelerate. In the short term, we can deploy vehicles that are coming off lease or in our dedicated fleet to rental. And in the long term, we can increase our rental capital spending later this year, which would primarily benefit earnings in 2027 and beyond. At quarter end, trucks represented approximately 60% of our rental fleet, reflecting our shift in spending towards trucks versus tractors in recent years, as trucks have historically benefited from relatively stable demand and pricing trends. Our full year 2026 capital expenditures forecast at approximately $2.4 billion is above prior year. We expect approximately $500 million in proceeds from the sale of used vehicles in 2026, in line with prior year. Full year 2026 net capital expenditures are expected to be approximately $1.9 billion. Our high-quality contractual base is generating higher earnings and cash flow, which is delevering our balance sheet at a more rapid pace than prior to our business model transformation. This momentum is creating incremental debt capacity given our target leverage range of between 2.5 and 3 times. As shown on the slide, over a 3-year period, we expect to generate approximately $10.5 billion from operating cash flow and used vehicle sales proceeds. This creates approximately $3.5 billion of incremental debt capacity, resulting in $14 billion available for capital deployment. Over the same 3-year period, we estimate approximately $9.5 billion will be deployed for the replacement of lease and rental vehicles and for dividends. This leaves around $4.5 billion, which equates to approximately 45% of our quarter-end market cap, available for flexible deployment to support growth and return capital to shareholders. We estimate about half of our flexible deployment capacity will be used for growth CapEx, and the remaining will be available for discretionary share repurchases and strategic acquisitions and investments. Our capital allocation priorities remain focused on profitable growth, strategic investments, and returning capital to our shareholders. Our top priority is to invest in organic growth. Aligned with these priorities, year to date, we funded lease and rental replacement CapEx of approximately $700 million and returned $406 million to shareholders through buybacks and dividends. Additionally, earlier in the quarter, our board authorized a new discretionary 2 million share repurchase program that replaced a program that was largely completed during the quarter. And more recently, our board approved an 11% increase to our quarterly dividend, marking the 4th consecutive year with a double-digit increase. Our balance sheet remains strong, with leverage of 259% at quarter end in our target range, and continues to provide ample capacity to fund our capital allocation priorities. With that, I'll turn the call over to John to discuss our outlook.
Thanks, Christy. Turning to our outlook on page 14, we've raised our full year 2026 comparable EPS forecast by increasing the low end of the range to $14.40 from $14.05, while maintaining the high end at $14.80. Our forecast continues to expect strong earnings performance in our contractual lease, dedicated, and supply chain businesses. The increase to our forecast largely reflects an improved outlook and reduced downside related to used vehicle sales, with gains now expected to be approximately $40 million for the full year, up $10 million from our prior forecast. This benefit is partially offset by the timing of new business onboarding in supply chain. Our 2026 return on equity forecast is revised to 18% from a range of 17 to 18%. This forecast remains in line with our expectations given current market conditions. Our free cash flow forecast of $700 million to $800 million is unchanged and reflects higher replacement capital expenditures versus prior year. Our third quarter comparable EPS forecast range is $4 to $4.20, above prior year of $3.57. Turning to page 15, our transform model is well positioned for earnings growth. We continue to expect 2026 earnings growth to be driven by incremental benefits from multi-year strategic initiatives. These initiatives represent structural changes we're making to the business and are not dependent on a cycle upturn. In 2024 and 2025, we realized $100 million in benefits, leaving $70 million of incremental benefits expected in 2026. This year's benefits will reflect our lease pricing and maintenance cost-saving initiatives in fleet management, our margin improvement actions related to our flex operating structure and dedicated, and optimization of our omni-channel network and supply chain. In addition to driving outperformance relative to prior cycles, our transform model also provides a solid foundation for the business to meaningfully benefit from the cycle upturn. By the next cycle peak, we estimate this potential benefit could be $250 million, with the majority expected to come from the cyclical recovery of rental and used vehicle sales and fleet management, with additional benefits from higher omni-channel retail volumes leveraging our rationalized footprint. We expect to recognize these benefits over time as freight market conditions improve. We now expect to realize approximately $20 million of upturn benefits in 2026, primarily from higher used vehicle sales results, up from $10 million in our prior forecast. In addition to benefiting our transactional businesses, we also expect additional opportunities for profitable contractual growth as freight conditions normalize and customers seek safe, efficient, and reliable capacity. We've been pleased by the business's resilience and performance over the cycle and are confident each of our business segments is well-positioned to benefit from the cycle upturn. In closing, our transformed business model continues to deliver value to our customers and shareholders. We continue to outperform prior cycles, and our results are benefiting from consistent execution and the strength of our contractual portfolio. We continue to see significant opportunities for profitable growth, supported by secular trends, our operational expertise, and ongoing momentum from multi-year strategic initiatives. We remain committed to investing in the future with products, capabilities, and technologies that will deliver value to our customers and our shareholders. We're confident our transform model provides a solid foundation for Ryder to meaningfully benefit from the cycle upturn. That concludes our prepared remarks. Please note we expect to file our 10-Q later today. At this time, I'll turn it over to the operator to open the call for questions.
Thank you. If you would like to ask a question, please signal by pressing star 1 on your telephone keypad. We'll pause for just a moment to allow everyone an opportunity to signal for questions. And your first question comes from the line of Bascome Majors with Stephens. Your line is now open.
Hey, good morning, and thanks for taking my questions. I would hope we could focus on the supply chain business a bit. A few months ago, the announcement of Amazon competing, and I know we've heard your initial comments on that, but big picture, as they've been in that market, maybe repackaging their offering a bit more formally for a few more months. What have you heard from your salespeople? Are they approaching the market differently? Do you still think it is a sort of shared warehouse, retail focus approach to the market, or is there some intent or desire to compete more in the dedicated site stand-up that you think could have more of a competitive response? Thank you.
Hey, good morning, Bascome. Let me make a few comments, and then I'll turn it over to Steve, who can provide deeper insights here. Clearly, from a supply chain perspective right now, that business, and we've seen it now for the last 18 months, continues to perform really well when it comes to the sales side of the house. So we haven't